From the outside, real estate can look like the cleanest tax game in America. You watch wealthy investors buy a property and everybody around them says they got a deduction. You watch them hold it and people say the cash flow is favored. You watch them sell it and somehow it looks like the gain gets pushed off into the future. So to an ordinary person looking in from the sidewalk, it can feel as if real estate always works in your favor. Buy a property, collect the write-offs, let the price rise, and when the time comes, step neatly around the tax bill. But that is not what I see when I look beneath the surface. When I look at the structures people use, when I look at the way transactions are actually reported, when I look at what happens once the IRS starts reconciling the story people told themselves with the way the code actually works, I see something very different. I see that a lot of people are not creating permanent tax savings at all. They are creating delayed tax consequences. Sometimes they are even making those consequences worse. And the strange part is that most of them do not realize the mistake at the moment they make it. That is what makes this so dangerous. In real estate, there is usually one quiet decision sitting underneath the whole deal. It determines whether you are truly preserving a tax advantage or whether you are just building a larger tax problem for later. Most people think they are choosing between properties, neighborhoods, rates, rents, and timelines. What they are really choosing is whether they understand the trigger. If you understand that trigger, then the rest of the real estate tax picture starts to make sense. If you do not understand it, you can spend years believing you are playing a fence while you are actually walking yourself toward a bill that arrives all at once. That is the part I want to slow down and make very clear, because once you see how the trigger works, then the bill that follows it becomes obvious. And once you understand the bill, then you can finally understand the behavior of people who are actually thoughtful about real estate tax strategy. They are not just hunting for deductions. They are not just chasing the next cost segregation study because somebody on the internet told them it was smart. They are not simply trying to make the current year look better. They are trying to control when the taxable event happens, how much income is exposed when it does, and whether they can legally avoid causing that event in the first place. That is the whole game. Most people never see it because they are watching the outside of the machine instead of the gears. They see the write-off. They do not see the reckoning. They see the depreciation. They do not see the recapture. They see the sale. They do not see the basis calculation waiting behind it. And because they miss those moving parts, they copy what wealthy real estate investors appear to be doing without understanding what those investors are actually optimizing for. That is why two people can hold what looks like the same kind of property and get radically different outcomes. One person thinks the property created a tax benefit. The other person understands that the tax code gave them a temporary advantage only if they respected the rules around the trigger. That difference in understanding is worth a lot of money. So let me walk through this the way I think it ought to be understood. First comes the trigger, then comes the bill, then comes the strategy that keeps the trigger from doing unnecessary damage. If you hold those three pieces together, real estate tax planning stops looking mystical and starts looking mechanical. And once it looks mechanical, it stops surprising you. The first place people get fooled is at the very beginning of the mental model. They think real estate is simple. They think the story goes like this. You buy a property, it appreciates. You collect the tax benefits along the way. Then one day you sell it for more than you paid and you walk away richer. There is truth in that story, but not enough truth. The dangerous omission is that the tax code does not care about the story the way investors tell it to themselves. The code cares about the moment consequences are triggered. That is why I always tell people that in real estate, the event matters more than the appearance. A property can make you feel smart for years and then punish you the moment you turn the wrong paper into the wrong transaction. That is not a philosophical point. That is how the system is built. There are certain moments in the life of a property that convert paper advantages into real tax consequences. Those are taxable events. People do not always recognize them because they are focused on the front half of the deal. They will say, I bought a property, I did a cost seg, I took the write-offs, I saved a fortune in taxes. Maybe they did help themselves for that year. Maybe they did reduce taxable income on paper, but that is only a one-year view. And one-year views are where a lot of tax trouble begins. Real estate is very often a tax deferral strategy. It is not automatically a permanent tax saving strategy. That distinction is everything. If you forget it, you start treating delayed tax as if it were vanished tax. And those are not the same thing at all. The usual moment of trouble comes when the property is sold. Sometimes the trouble is even uglier because the property is distributed out of a corporation without a sale, and the owner thinks that because no buyer showed up with a check, no real tax event occurred. The code does not reward that kind of wishful thinking. Once the transaction crosses into taxable event territory, the calculation begins whether the owner is emotionally ready for it or not. At that point, the question is no longer whether the property gave you deductions over the years. The question becomes how much gain is now exposed because of the event you just triggered. And that question is answered by comparing fair market value or sales price to tax basis. That basis is usually your original purchase price, increased by improvements and reduced by depreciation you claimed along the way. That reduction is where the trap often gets set, because every time you enjoyed depreciation, you lowered the basis. And every time you lowered the basis, you potentially increased the amount of gain that can be recognized later when the taxable event finally happens. So the very thing that felt like a benefit while you were holding the property may become part of the reason the later bill is so painful. That is why I say the trigger is the real dividing line. Before the trigger, many people feel as if the story is under control. After the trigger, the code starts adding up everything they thought had been safely buried in the past. And that is where the second part enters. The bill, once the taxable event happens, this is where the fantasy usually breaks down. I have watched people talk about real estate as if it were a machine that simply prints tax savings. Then they sell. Then the IRS starts reconciling years of deductions in one concentrated moment. Then suddenly the owner realizes the tax story was never as simple as it looked in annual snapshots. Every year they claimed depreciation, they lowered current taxable income. That felt good. It may even have been entirely proper. But when the taxable event occurs, those deductions do not just dissolve into history. The IRS does not say, fine, keep the benefit and let us pretend none of that happened. The IRS starts matching the prior benefit to the current event. And that is where depreciation recapture enters the room. This is one of the biggest disconnects I see in the way people talk about real estate. They hear the word depreciation and think permanent win. They hear the word deduction and think free money. They rarely think in terms of reconciliation. But the government does in real estate. That reconciliation often shows up as unrecaptured Section 1250 gain taxed at rates up to 25%. That is one layer. Then above that, you can still have capital gain on the appreciation over original purchase price and adjusted basis. So now you are not facing one neat, clean tax category, you are facing multiple layers. You have recapture, you have capital gain, and if you structured earlier deductions in a way that changed the character of what was depreciated, you may have made the recapture layer worse than it needed to be. That is where cost segregation becomes so misunderstood. I am not saying cost segregation is inherently bad. I am saying a lot of people praise it without carrying the thought all the way through. They look at the accelerated deduction on the front end and stop the analysis there. That is the kind of thinking that makes people feel clever in year 1 and confused in year 7, because what a cost segregation study can do is change the character of part of the property for depreciation purposes. Instead of leaving it all in a longer life real property bucket, parts may be treated as shorter life tangible personal property that can accelerate deductions. It can also change the recapture profile later, and that matters. If an amount would have stayed in ordinary real property treatment and later faced recapture at a maximum 25% rate, that is one outcome. If a structure converts that same amount into assets recaptured at ordinary income rates that can go up to 37%, that is a very different outcome. And people who celebrate the front-end deduction without respecting that difference are often celebrating too early. Use a simple example. Suppose accelerated depreciation through cost segregation totaled $240,000. If that amount had remained in the real property bucket and later faced recapture at 25%, the tax would be $60,000. But if that same $240,000 has been shifted into a category that is recaptured at ordinary income rates up to 37%, the tax becomes $88,000. That is an extra $28,000. Nothing magical happened. No hidden trick, no conspiracy. You simply changed the character of the depreciation and later the back. End tax treatment reflected that change. This is the part that separates surface level tax enthusiasm from real tax understanding. A lot of real estate tax planning is not about whether a move creates a deduction. It is about what price you may be agreeing to pay later in exchange for getting that deduction sooner. That timing question matters because time has value. Deferral has value, but deferral is not the same as elimination, and it becomes dangerous the moment you confuse those two words. If all you are doing is pulling tax savings forward while leaving a bigger tax bomb waiting on the sale side, you need to know that. You may still choose to do it, but you should never choose it under the illusion that the back end disappeared. So once the bill is understood, the behavior of more sophisticated investors becomes much easier to read. They stop asking the childish question, how do I get the biggest deduction this year? They start asking the adult question, how do I avoid triggering the event that forces the full reconciliation? That shift in question is where real strategy begins. The strongest real estate tax players are often not trying to beat the code. They are trying to move through it without stepping on the mines. That means they think very carefully about when a property is sold, how a disposition is structured, whether an exchange can be used, whether a property is worth carrying longer, and whether fresh capital should be deployed into new assets rather than relying on old basis recycled through repeated transactions. That is the part that people miss when they copy wealthy investors by imitation. They see the investor still buying. They do not understand that the investor may be buying new basis while deliberately avoiding the event that would detonate the deferred gain in the older property. That is a very different game from simply buying whatever is popular and assuming real estate is tax favored by nature. The first major strategic tool people point to is the 1031 exchange used properly. It can be powerful. Used casually, it creates a new kind of disappointment because people think they completed an exchange when they only completed part of one. The purpose of a properly executed 1031 exchange is straightforward. If you dispose of one qualifying property and reinvest into another qualifying property under the rules, recognition of gain can be deferred. That means no immediate capital gain. It also means no immediate depreciation recapture. Legally, the gain is not erased. It is carried from the old property into the replacement property and left unrecognized for now. That phrase matters. For now, again, this is the language of deferral, not disappearance. And once you think clearly in those terms, you start respecting the mechanics. I have seen plenty of people sell a property, collect the cash, breathe a sigh of relief, and only afterward ask how to do the exchange. By then they are asking the wrong question too late. Once the sale has been handled the wrong way, no amount of regret will convert it into a proper exchange. And I have also seen people misunderstand the financing side, which is just as costly. They think that if they roll over the cash they received, they did what they needed to do. Often, they did not. Suppose you sold a $1 million property with a $200,000 basis and an $800,000 loan. A person who only thinks in terms of net cash might imagine that reinvesting the $200,000 of net proceeds is enough. It is not enough for full deferral. To fully defer the gain, you generally need replacement property of equal or greater value, and you need to replace the debt that disappeared, either with new debt or additional cash. You do not get to reduce what must be reinvested, simply because part of the property had debt on it. That misunderstanding is one reason people think they completed a beautiful exchange and then later discover they triggered taxable gain anyway. And even where the exchange itself is handled properly, reporting still matters. If the transaction is not properly reflected on Form 8824, then from the IRS perspective, the return may not tell the story the taxpayer believes occurred. That is another lesson people learn too late. Tax strategy does not end when the transaction is done. It ends when the reporting correctly matches the transaction. The code is full of people who thought substance would rescue careless paperwork. Sometimes it does not. So a properly executed 1031 exchange can extend the deferral story. It can move gain forward, it can postpone recapture, it can keep capital working in the next property instead of sending a large piece of it to the government immediately. But if you want to understand how some investors think even further ahead, then you have to go beyond exchange logic. Because the bigger goal is often not merely to defer the taxable event from one property to another. The bigger goal is to avoid voluntarily triggering it at all. That brings us to the holding period mindset. A great many people think the purpose of investing is eventually to sell and lock in the gain. Sometimes that is true, but once you understand the tax law, you realize that there are situations where the economically intelligent move is not to sell. It is to hold if a property is held until death. Basis generally steps up to fair market value. That is a simple sentence with enormous consequences. The deferred gain disappears from an income tax standpoint. The recapture problem disappears from an income tax standpoint. The property is reset to fair market value for basis purposes, and it can be as if the old gain never had to be recognized in the way people feared while the owner was alive. Now, that reality changes the way a thoughtful investor sees the whole board. They are no longer just asking whether a property appreciated enough to justify a sale. They are asking whether the tax cost of selling is foolish compared with the benefit of continuing to hold. They are asking whether the property is worth carrying for the long term. They are asking whether liquidity can be created in other ways without voluntarily creating the taxable event. And that is where another common misunderstanding appears. Many people assume that if you need liquidity, you must sell. But once you understand why the trigger matters, you begin to see why some investors prefer to borrow against an appreciated asset rather than sell it. The reason is not romance. The reason is tax awareness. If selling triggers the gain and borrowing does not, then borrowing may preserve the structure in ways selling would destroy. Again, this is not about playing games. It is about understanding what the code rewards, what the code punishes, and what the code postpones. The investor who sees that clearly behaves very differently from the investor who merely wants to cash out whenever a property looks successful on paper. And there is one more piece people routinely miss. When you carry property through a 1031 exchange, you do not magically create fresh basis in the new property in the way beginners often imagine. The old basis carries forward. The deferred gain carries forward. That means the replacement property does not simply hand you an entirely new batch of clean write-offs as if the past had been wiped away. So if an investor wants fresh depreciation opportunities at the same time they are continuing to defer old gains, they often need new capital. They need to buy more real estate with new money. New basis, new depreciation. This is another reason the outside view is so misleading. A casual observer sees an experienced investor buying again and again and assumes each purchase is just another version of the same move. It often is not. One property may be carrying deferred gain from the past. Another property may be brand new capital, creating brand new basis. One part of the portfolio is preserving old deferral. Another part is generating fresh deductions. And if you do not understand that distinction, you will never really understand what the investor is doing. You will just think they have discovered some secret. Where real estate always creates tax blessings, that is not the truth. The truth is usually more disciplined than that. They are controlling the timing of taxable events. They are respecting the basis rules. They are watching how depreciation changes later consequences. They are being careful not to confuse a current deduction with a permanent victory. And when they do use cost segregation or accelerated depreciation, the better ones understand the trade they are making. They know the front end benefit may come with a back-end cost. They know recapture can show up in a more expensive form depending on how the depreciation was characterized. They know that a larger deduction today can become a larger tax headache tomorrow if the eventual exit is handled carelessly. That is why I always come back to the same point. Real estate tax strategy is not mainly about getting a deduction. It is about understanding what event turns that deduction into a later bill, and then structuring your life so you do not trigger that event unnecessarily. That is the discipline. That is the seriousness. That is the difference between someone who studies tax consequences and someone who chases tax slogans. A lot of people in real estate love to speak in phrases: cost seg, bonus, depreciation, tax-free, write-off, shelter, passive losses. Those phrases can all mean something. They can also become a vocabulary of self-deception if the speaker does not understand how the pieces fit together over time. The tax code is patient. It does not need you to misunderstand it today. It can wait until the sale. It can wait until the distribution. It can wait until the return is filed incorrectly. And then, all at once, it can make the misunderstanding very expensive. That is why I like mechanical thinking in tax matters. What triggers gain? What lowers basis? What creates recapture? What carries forward? What resets basis? What must be reinvested? What must be reported? Once you can answer those questions, a lot of the glamour disappears and the structure becomes visible. Then you stop admiring how tax efficient a deal looks from the outside and start asking whether the owner has actually preserved that efficiency on the inside. That is a much better question. If you take nothing else from this, take this. The mistake is not paying tax. The mistake is believing you created a tax benefit when all you really did was postpone the tax or make the later bill larger. That is the error that catches people. They celebrate too early. They think the deduction was the ending when it was only the opening move. They think the depreciation solved a problem when it may have only shifted it into the future. They think a sale is just a victory lap when it may really be the moment the ledger finally balances. Once you understand that, your behavior changes. You start paying attention to the trigger instead of the headline. You stop copying the look of wealthy investors and start studying the structure underneath their behavior. You understand why a sale can be costly even after years of tax-favored treatment. You understand why a 1031 exchange has to be executed properly from start to finish. You understand why debt replacement matters. You understand why reporting matters. You understand why holding until death can transform the tax result. You understand why borrowing against an asset may preserve a strategy that a sale would destroy. And you understand why buying more real estate with new capital can create fresh deductions while older properties continue carrying deferred gain. That is what serious investors are usually doing. They are not just buying properties. They are managing the moments when gain becomes real, when recapture appears, and when the government finally gets paid. Sometimes the smartest move is not to outrun the code. It is to stop tripping the wire. I have spent enough time around capital to know that people usually lose money in taxes for one of two reasons. Either they never learned the rules, or they learned only the attractive half of the rules. Real estate punishes the second kind of ignorance particularly hard, because the front end can look wonderful. The write-offs can feel intelligent. The depreciation can make the current return look elegant. And if you stop the analysis there, you can convince yourself that the property has done something permanent for you when, in fact, the real question has merely been deferred. So if you are going to own real estate, and if you are going to talk seriously about tax benefits, then talk seriously about triggers, talk seriously about basis, talk seriously about recapture, talk seriously about exchanges, talk seriously about step-up in basis, talk seriously about what happens when a transaction is reported incorrectly, talk seriously about whether you are creating new basis or merely carrying old basis forward, because that is where the truth lives. And the people who do best in this world are usually not the ones who found the flashiest deduction. They are the ones who understood the system well enough that it stopped surprising them. That is the standard I would hold for any real estate strategy. Not whether it sounds clever at a dinner table, not whether it looks tax-favored on social media, not whether somebody tells you rich people do it. The standard is whether you understand exactly what you triggered, exactly what you deferred, exactly what you carried forward. and exactly what bill is waiting if you choose the wrong exit. If you understand that, you are no longer guessing, you are no longer copying appearances, you are finally seeing the machine for what it is. And once you see it, you stop asking the shallow question, how much can I write off this year? You start asking the only question that really matters, what event am I building toward, and do I actually want to trigger it at all?